Hey folks, David Frost, my strategic forecast. You're here for another episode, Common Sense Market Analysis. Today is Friday, October 6, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And what do you know, we had a down day today. Pretty interesting development. We were down 43 cents or almost 0.2%. We're not used to seeing a down day, even though there's a green candle, so it's trying to fake us out. And that's the reason is because the market gapped lower and closed above the opening print, and that's why you see a green candle. But it was a down day, and I know that is an oddity, so we have to talk about it a little bit. So what does it mean? Well, it doesn't really mean anything just yet. We know the market's overcooked on the upside. Nothing has changed. We are in a very strong uptrend, which will eventually come to an end, and the market will either consolidate or correct one way or the other. But right now, we're still in an uptrend. You can see the moving averages moving higher. As they move higher, price can move higher, although in terms of the 20-period moving average, just like discussed last night, the market is extended or stretched from the 20 moving average, which I like to call home base. So one of two things has to happen, and I'm sorry to be repetitive, but it's important information. The market's either going to have to consolidate and eat time off the clock, allowing the 20-period moving average to catch up to price, which essentially resets the market and gives the market a chance to rebuild some energy for a potential move higher or another move higher. Or the second option is for the market to actually pull back a little bit and come back into the 20-period moving average, which is the more likely scenario, but we don't know which one is going to take place just yet. Eventually, the market will certainly find an area where it's got to pull back from. We have on the chart the 256.57. The high yesterday, let me move the chart over. The high yesterday was 254.68. The high today was 254.70. Made a new high by 2 pennies, but didn't finish at the high, obviously. So we didn't quite get to the 256.57 yet. It's still a possibility, but eventually the market is going to have to pull back. But until and unless we see the signs or signal of a reversal or trend change, all we can do is wait for the market to tell us what to do. Even this morning, with a phony jobs number worse than the market was expecting, and maybe that was part and parcel to the reason why the market was down. I'm sure it was part of the reason why the market was down early. There was no selling pressure in the market. When you look at the volume, there was a little bit of a pickup in volume today, 80 million shares, but 80 million shares and the market was only down 43 cents, or the Spider was. The S&P 500 was down less than 3 points. That's not a sell day. That's a rounding error when you have an index at $2,549. So there was no selling pressure out here in the market, and without any kind of volume, any kind of selling pressure, it's very difficult for the market to find any downside activity whatsoever. So we had a phony jobs number. It was poor. There was no selling pressure to be found out there in the market, and therefore, essentially, the market floated the remainder of the day. When you go to an intraday chart, look what happened. We have a down move. We had a little bearish wedge pattern, another down move. The market found a low, and then we floated sideways to higher the rest of the day. And then, of course, the magic hand came out in the last candle of the day, which was 4.5 million shares, pushing the market higher in the last few minutes of the day. That happens more often than not, and specifically on a Friday afternoon, the market is very quiet. The path of least resistance when the market is quiet is higher, and that's what we saw into the closing bell. So we can't really gain any meaningful information out of today's activity, so what we'll do is move on to the IWM. Now the IWM also down slightly today, but not enough to really make anything out of it. 29 cents, 0.2%. It's really nothing. We're sitting up here at 149.97, basically $150 in the IWM, all the way down from a low of around 134 just 6 or 7 weeks ago. We are building a sideways bullish consolidation pattern. We are above that upsloping trend line that was the all-important trend line drawn over from the monthly chart. We obviously did close above that line for the month of September. Now we're in the early part of October, and we're still obviously above that line. We are extended from the 20-period moving average just like the spider is. So what you see the IWM doing is eating time off the clock. As you can see, as we're going sideways, the 20-period moving average creeps up closer to price, which gives the market a chance to reset and potentially build some energy for another move higher. Now, are we actually going to get another move higher before any kind of correction takes place in this market? It's certainly possible. Again, still not really probable, at least in my mind. The month of October still has a very good chance, from where I sit, to be somewhat of a volatile month. We are getting into earnings season. Earnings season can certainly bring volatility back to the market. So I wouldn't necessarily, write off the market just yet as going to continue to go higher each and every day for the remainder of the year. There still could be a corrective phase in this year before an end-of-the-year rally. Earnings season should certainly bring some volatility back to the market. Will it? Well, that remains to be seen, but we get kicked off really next week, and we'll see what happens when the bank's earnings are released, and then all the other companies' earnings are released, and we'll see what happens with the market volatility and what the market does to those stocks based on their earnings announcements. Doesn't really matter what they report, it just matters what the market does after they report. Do they send some of these stocks lower, dragging the indexes with them, or do they slough off any kind of maybe perceived bad news and send the market higher? We'll see what happens, but I wouldn't write off the month of October just yet. It does have a tendency to be a volatile month. Here we are in the transports, and what we did discuss last night on the transports is, are the transports going to be ultimately the canary in the coal mine that tells us that there's trouble ahead in the market, and maybe if we do get volatility in the month of October and some downside action in the market, maybe it was the transports that ended up topping out first. Certainly possible. We'll see what happens, but we had another slight down day in the transports, about on par with the S&P, about on par with the IWM, certainly from a percentage perspective. But again, it was down 22 points, 0.2%, slightly more than that. But we did top out a couple of days ago, and we'll see if that holds, or is this just a pullback, getting closer to the 20-period moving average, or letting the 20-period moving average trade up into or move up into price, and will that reset the market, and will this just be another bullish pullback pattern? So we have an up move, and if we just did this could certainly be another bullish pullback move setting up for another higher move. That's possible, but the telltale sign is going to be how the market reacts to some of these earnings and whether or not any significant volatility comes back into the market. Remains to be seen. We have to wait and see. We have to wait for the market to tell us what the next likely scenario is. It always will tell us. It's just a matter of whether we can read it or not. Right now, in any of the markets that we follow, there hasn't been a signal of a trend change. There hasn't been a reversal. There hasn't been anything except bullish behavior. So we're just watching everything like a hawk. And the minute we see something, or the minute I see something that sparks an interest that could be more meaningful and could potentially tell us that there is some downside activity coming, then we'll obviously talk about it here. Until and unless that happens, everything is basically bullish. Gold. We talked about gold coming down to the 1262 area. Didn't quite get there. It got as low as, let me move this over. It got as low as 1262 spot 80. The gap, and you can make an argument that the gap was either 1262.90 or was the gap at 1262.60. Either way, that's close enough one way or the other. We talked about 1262. I thought the market would come down to 1262. Today it came down to 1262, and as soon as it did, it had a pretty nice rocket ride higher. When you look at the intraday chart, here's your 1262. Okay, the low was 1262 spot 80, And as soon as we hit that level, you can see what happened. We started higher, and that tells you, or I should say it tells us, that this was a pretty decent bottom that's in place for now. It doesn't have to be a long-term bottom. It doesn't have to be anything more than several days of what I believe to be at least a bottom for the time being at 1262 in that general area. This is a nice tail candle. We hit the number I was anticipating, and we had a nice intraday rally off that. That's a market reversal, an intraday reversal in no uncertain terms. We found some resistance up at the 100 period moving average at 1278.7. The actual high today was 1279.20. We backed off that, but we should have several more days of upside activity in the gold market from here. So all in all, that played out pretty well. Going over to the silver market, same routine in silver. You see the 1640. We pierced it by a few cents. The low today happened to be, I didn't move it over enough. The low today happened to be 16.345, and we had a nice rocket ride higher off that level. Same intraday reversal, same routine. There should be more upside coming into next week. Now, what's interesting is, are the metals trying to tell us something? Are the metals a potential canary in the coal mine? Are the metals going to rally as a stock market pulls back? It's certainly possible. You could get some more discussion about some geopolitical events. You always have North Korea lingering out there and Rocket Man. We'll see. It's a little early to tell, but as far as I'm concerned, gold and silver should have bottomed and have more upside coming at least into next week. Those were two pretty good calls on gold and silver. All right, crude oil. Pretty interesting what happened in crude oil. We talked about it yesterday, and I think it's worth mentioning again. We have two trend lines on the chart. So the shorter term trend line, which is significantly at a steeper angle, was touched yesterday, and the market was rejected at that level. That was the cross between the 200 period moving average coming into that trend line, or vice versa, the trend line coming into the 200 period moving average. When price got up to that junction box, if you will, it was rejected. And even though yesterday was a pretty decent up day, it was a one-day wonder, and the market came down pretty significantly today, being down about 3%. Now, because we came down the way we came down today, I have to believe we're coming down to what level I discussed before, which is the 48.50 level, in that neighborhood. If that doesn't hold, then I have to believe that this upsloping trend line will hold, and that'll come in, depending on what day we hit it, right around 48. Maybe if it's slightly into next week or deeper into next week, it could be 48.25. And if it's on Monday, it could be down of a pierce of 48, down at 47.90 and change. It's a little bit of a moving target because it's an upsloping trend line. Each and every day that passes by, the trend line is at a higher price. But that's what I think is coming if the 100-day moving average doesn't hold at 48.5, and we know 48.5 should be a pretty decent support level for the crude market, then this trend line should hold at least for a few days, if nothing else. Remember, going back several days, I really wasn't convinced that we were going to get much higher than this, and that turned out to be the case. I obviously didn't short the market there, although I should have. Hindsight is 2020, Monday morning quarterback stuff, but nevertheless, that was the resistance point that certainly provided a pretty decent pullback from that level. 53 all the way down to 49 in a matter of a few days. It's certainly an easy trade after the fact, especially when you didn't have a position. All right, going over to the bond market. So we did see the bearish pattern begin to play out today, although we did get a rally off of a level that is really this double bottom here in this area. Okay, so we didn't come down to the level I thought we would yet. Doesn't mean we won't, but we have these pivots down here, and that provided some support for the market. And it's probably easier to see if I just draw it in. So you have some pivots down here, and you can see where we came today. Well, we didn't even quite get to there. We really came up short even those pivots. I don't think that's a meaningful area that the bond market stopped short today. The only thing that I'll say is, and I don't like to correlate markets, as you know. However, I'm going to correlate markets for a minute. If, in fact, the gold market is going to rally, And if it's rallying on the quote-unquote fear trade and the stock market is coming down, and I'm fast-forwarding into next week, right? Let's just say that's the case. It's a hypothetical case. Then it makes sense to me that the bond market would actually catch a bid and rally a little bit rather than coming down to the level that I thought we would get to, which is right around the 200 period moving average, this double bottom area down here. That's where really I thought we would get to, and I still think we have a very, very strong chance of getting there. We may not have just, we may just not have been able to do it all in one day, but you can see from a symmetrical standpoint, you have a big down move, you have sideways consolidation, and this down move is about equidistant to that down move. So to me, that makes total sense, and you have the double bottom area, the 200 period moving average. The market really should get to that area for more than one, even more than two reasons. It's really like three reasons why I believe the market will get down to that 200 period moving average. Just didn't get there today, that's all, but I think it will. And let's go ahead and look at the good old Dixie today, and today is Friday. It's the close of the week, and what a surprise. The dollar went for the 100 period moving average. We talked about that last night. I didn't necessarily think it was going to get there today, but it got there today, or it came very close. It didn't actually hit it. We got above that 93.835 level. That's been important. We closed on it yesterday. We got above it today, although the market was rejected and we closed below it today. So that's not really that important of a development because we can certainly move sideways up here for a few days, and that would build energy for another move higher, and that would solidify the concept that this is actually a low for the dollar. But what I'm more interested in is the weekly chart. Okay, so the weekly chart, we closed above the 200-week moving average. That's positive. And this is really the level that they hit today, was the 20-period or the 20-week moving average. That seemed to be the level they were going for, but they still closed below what I believe is an important level at the 93.835. We still could be in a position where this is a low. That's certainly possible. I'm not 100% convinced yet, but as the days go on and as the weeks go on, I become more convinced. Closing above the 200-week moving average, positive. A touch of the 200-week 20 moving average is not necessarily positive or negative. The fact that we touched it and backed off a little bit is normal, common market behavior, so that's expected. We haven't seen the 20 moving average in quite a while. This has been in a pretty persistent downtrend. So on the first hit of the 20, after not seeing it since April of this year, so we have had several months trading away from the 20 moving average on the weekly chart, and we touched it and traded away from it. That's common and normal market behavior. I think what the market would really want to do is consolidate for a while to get through this area, and I'm becoming more and more open to that idea. We'll talk more about it next week, but at least a positive week, another positive week for the dollar. So I'm becoming more and more open to the idea that we have seen a bottom. Not 100% convinced yet, but I'm more convinced than I was certainly last week when we failed to close above the 200-week moving average. So that's where we stand on the dollar. And with that, it's everything I wanted to discuss tonight, so I'll wrap it here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.